What's good, traders? Welcome to day 6 of the bootcamp. I'm super pumped. I'm super ready for today because today we are going to be looking at chart patterns. Chart patterns is what I use on a daily basis to look for entries, to look for setups, and to make sure that I can make profit in the markets. And after this video, you are going to be ready and pumped to make money in the markets. But disclaimer, guys, I don't want you guys to just use my patterns to the T and not actually trial it. I want you to try it and I want you to practice it and back test it to see if it works for you, okay? Because what I see in the market might be a little bit different to what you see in the market, and that's completely fine. You just need to practice and train your eyes to see this, okay? I've been trading for 5 years, so when I look at these patterns, I can locate these patterns quite easily. But for someone who's a beginner or someone who has been trading or has not been looking at the markets for so long, especially if you don't know these patterns, what's going to happen is you're going to force these trades and not actually hit the correct trades and the correct setups. So what I advise you is train your eyes, practice these setups, and once you practiced it, go on your live account or your funded account or whatever it is and trade it, and you'll start to make profit. Now, before we get started, make sure you guys like and subscribe, but not only like and subscribe if you're part of this bootcamp, but also turn the bell notification on, okay? Because we are uploading every single day, Monday to Saturday. We take Sunday off because I want Sunday to be the time where you do your homework and Sunday to be the time where you actually just evaluate yourself and take a breather, and we get right back on Mondays at 8 p.m. UK time, okay? I do that every single day. I'm committed to do this, so I want you guys to also be committed to watch and learn. And if it means that you are learning but you're not understanding, it's fine. Comment it down below and I will respond to you. If you look through the comments, you'll see that I'm already responding to a lot of people. And if you are confused, do not be shy to ask that question, even if it's the most simplest question, like, hey, I didn't understand setup 1, okay, or I didn't understand setup 2. It's completely fine. Just comment it. Do not be shy, because at the end of the day, if you don't ask, you will not get further to where you want to be. You need to ask to get to places, okay? So I'm gonna take my time out every evening to look at the comments and respond to you guys. I want you guys to not to be shy and ask me questions, because this is the whole point of the bootcamp. Even though I'm not right next to you, I want you to feel like I'm right next to you, by your side, supporting you in your trading journey. But other than that, guys, let's get right into the chart pattern. So we actually have around 2 setups when it comes to the markets, okay? Now, it's very simple, okay? These 2 setups have different variations, and I'm going to go through them, but they're very, very simple, okay? They're not something that you need to overcomplicate. They're something that you can actually develop on, but these are the best methods that I've used when it comes to the market. So the first setup we're going to look at is called a double top or double bottom, okay? And simply what it looks like, right? It's like a W. So that's one method, one way. And the other way is like this, okay? And they're very similar to each other. And the reason why we call it a double top and double bottom is because price retests the same price or the same area twice, okay, causing a W and an M formation, okay? So what I'm actually going to do is I will actually write the name, so double top slash double bottom, okay? Now this setup that we've got going on, yes, it looks super simple, but we need to know how to find entries and how to find these setups, right? Because you can't just see a W formation and trade it, because most likely that formation is done, it's completed, that setup is finished, okay? So how do we trade this? Okay, so what I'm going to do is I'm just going to break it down. So let's look at the W formation first. So when we look at the W formation, we need to understand how this works. So what I like to call these moves is, this is a leg to the downside, okay? Now, usually when we have a leg to the downside, we need to see some sort of confirmation that price is reversing towards the upside, because this could just simply be price coming down, going up, and then continue going down, right? So we don't want this setup. We want it to have a confirmation of a reversal. So like I said in my candlestick patterns, right, the cheat sheet that we have, we need to see one of those candlesticks to confirm to us that we have a reversal, okay? So if I just write on keynotes, okay, wait we'll have wait to see a reversal. Okay, it's very, very important that you're patient when it comes to the double top and double bottom, because you can force the trade and you can lose a lot of money when it comes to this. Okay, now what I like to do is, it depends on my mood for the day, but what I like to do is there's two methods of entering this market. Okay, the first method is entering the market when the market retests this zone. Okay, when the market retests this zone here, right, that is my indicator to, okay, we are entering. Okay, and the only time I would enter is if price gives me like this impulsive move to the upside, like an impulse, and maybe some internal break of structure, then I would enter the market. Okay, stop loss below these lows, because I do not want to lose. If the market continues to go down, for example, if the market continues to go down like this, then I'm out of the trade, because then I don't need to actually be in this trade. Okay, so we got the first touch at this area. Okay, goes up. Okay, we have internal breaker structure. We understand that price could be coming down, going up, sorry, reversal. Then price comes down to that same area, retesting these buyers. Okay, and usually what price might do is it might just stop out these buyers as well, which I know some traders call it, I think it's inducement. Okay, but in reality, it's basically just stopping out traders that have entered, the early buyers. Okay, what we would do is we would wait for that secondary push. Okay, and another key note, right, is wait for an impulsive candlestick. Okay, candlestick. Okay, the reason why I say this is because if you're a trader and you're trying to, let's say for example, you're trying to trade a currency pair and you don't see an impulsive candlestick and you just hover around on like a doji, what's going to happen is you're going to have a bit of drawdown. Well, whereas if you have an impulsive move to the upside, what will happen is when you enter, most likely because of the momentum of that candlestick, you will go straight into profit, giving you a nicer entry, and it won't play around with your psychology. Okay, now when it comes to targets, right, we need to make sure that our target is at the top of the leg. Okay, the top of this leg. We're not going to target anything super high, like to another level of structure, because that's not the setup. The setup is to the top of this leg. Okay, now the second way of trading this, okay, which we're going to go a little bit down, is the first approach is more aggressive, and this is if you are confident as a trader and you don't mind having a little bit of a larger stop loss. Okay, you don't mind that as long as you have the take profit. So you want to be, this is more aggressive. Okay, a more of aggressive approach. You still will hit take profit, you still will hit a good profit margin, but it's a little bit more aggressive. Okay, the second approach is you see price reacting quite well. Okay, and what you do is you wait for price to retest something called the neckline. Okay, so these are the bottoms and this is called the neckline. Okay, this area right here. So this area is called the neckline, and what that does is it builds a level of liquidity, or we could say a level of resistance slash support. Okay, so what we do is you can now wait for price to come back to this area, which is now giving you an opportunity, and you can place your buys, stop loss nice and tight, right? Probably just below maybe market structure, and targeting again the highs of the leg. Okay, so this is the leg, this is the bottom, that's the neck, that's the second bottom, and we go up, causing another leg, and then we retest the neckline, and then we're hoping that price goes up. Now, as you can see, the difference between these two trades is, number one, this risk to reward ratio is a 1 to 2, whereas this risk to reward ratio is almost a 1 to 4. Okay, so instantly, when you're an aggressive trader, your risk to reward ratio is going to be smaller, right? Because your stop loss is larger. But if you have a look, when it comes to patience and you actually wait for the right confirmation, majority of the time, when you wait for this retest to the neckline, most likely you would have a really good entry, almost like a sniper entry, giving you a nice 1 to 4 risk to reward ratio. Okay, so it's the same thing, same principle, exactly the same principle, but this time we're just being a bit more patient and we're waiting for more confirmations. The confirmations in this one is that we just have a double bottom. But guys, when you're aggressive, you need to understand that price can easily crash down to your stop loss, right? Whereas with this one is we have built internal structure, right? Causing a higher high, right? A higher high. Now we're retesting, right? Giving us an opportunity to enter the market at a lower, a cheaper price, but also continuing off with this impulsive move to the upside, okay? Now, with this kind of setup, because we have that internal breaker structure, right, we most likely will get to this level right here. Most likely. Why? Because price has attempted. There's no reason for price to just crash down at this level unless there's news or something that is just not your fault, right? There's always methods, there's always, sorry, chart patterns where it's clear as day, but you know the market just decides to not go in your way. That is totally fine. This setup right here works around 7 to 8 times out of 10, okay? I'm not going to say that this pattern works 100% because no pattern in the world works 100%, but when I trade these patterns, most of the time I am in and I hit profit and I'm out, okay? So this is setup number one. Now this is the double bottom. I'm going to quickly show you double top. It's pretty much the same principle. So double top, okay, you could do the same thing where you enter at where price has caused a resistance, okay, and you enter for a short, okay, and you put your stop loss just above, okay, and then targeting down here, okay. This is one setup, okay, and you can do the same thing, but this time be a bit more reserved and wait for price to retest this neckline, okay, retest this neckline, and then entering, which gives you a better opportunity. Okay, stop loss just below internal lows, and obviously targeting there. Okay, pretty much the same thing, but this time is the reverse. Okay, the reason why you need to understand the reverses as well is because price can cause a double top or double bottom. It's the same setup. Okay, so it's good to be on the bullish side and also on the bearish side. Okay, now there's a few notes that I want to kind of explain to you on through the years of my trading, because yes, this sounds like a really, really good setup, but there's a few more notes that I want you guys to write down, put it in your notes and follow through. Is number one, or actually just continuing off actually, is uh, only trade these patterns if it's at a round psychological number. Okay, what I mean by this is only trade if you see, let's say, for example, price is at 1.1, right? Or at a round psychological number or a key level, right? So only trade, spot these wrong, okay? And this is for pretty much all the setups. Doesn't have to be exactly at a round psychological number, but I always see a higher percentage of wins when it's at a round psychological number, right? Because that's where most reversals happen. That's where most of the time we get to move onto the other side of the markets, right? Okay, this is more of a reversal pattern, not a continuation pattern. So as a trader, you need to understand that if there is a reversal, you are on that trade, but you are being patient. Okay, so with all these patterns, I am going to say one thing is be patient when it comes to these, right? As you can see, if you're an aggressive trader, you're going to have a larger stop loss with room for price to go the other direction. Whereas if you're conserved and you're being a bit more patient, you actually wait for this. Yes, you're missing out on all these pips, but if you actually just wait, you can get a higher risk to reward ratio, maybe less few pips, but you can risk a little bit more and get a better return and a higher win rate based on you just being patient. Okay. And that's setup number one. So remembering that trade on these patterns with round psychological numbers, wait for an impulsive candlestick at all times. This is just an entry protocol that you should always use. Always wait for an impulsive candlestick. Impulsive candlesticks are basically Marubozus or a big engulfing candlesticks or just a strong momentum to the upside or downside depending on what the trend is. And again, you can only see this double top or double bottom if you see a reversal candlestick formation, okay, which is on our candlestick cheat sheet. Okay, if you guys want the candlestick cheat sheet, it is if you join my Discord server, I will personally send you the file so that you can download it, print it out, or stick it on your walls or whatever it is, and you can actually use it on a day-to-day basis. Okay, so join the Discord, link is in the description. It's completely free, there's no catch to it, completely free. I'll send you the file and you can download it, do whatever you want with it, and you get to have it right in front of you. Okay, now the second setup, which I use predominantly on higher time frames, but you can still use on a lower time frame as well, and it's called head and shoulders. Okay, head and shoulders, yep, I know it sounds funny, okay, but it's very, very simple. Okay, and I know it might look very, very difficult at first, and just a disclaimer, guys, these setups, they're not going to be very easily visible seen, right? You won't be able to see it easily. But once you train your eyes to notice these setups, you will start to notice them a bit more faster. And we're going to, later on in the video, we are going to look at the market. We are going to look at how the market shows us these patterns. So I can show you an example that is not going to be to the T, or it's not going to look exactly like this. But what we can do is we can use this information to trade and practice. Okay, and that's why I'm saying to you guys, you need to practice these patterns, because what's going to happen is you're going to see something similar to this and you're going to hit a loss. Whereas if you just wait for a better example or better setup, what will happen is you will see a higher chance of win rates. Okay, so with head and shoulders, it's pretty simple. Okay, the setup looks like this. Okay, this is a head and shoulders. Okay, now I know this looks really, really weird, but all you guys need to know is this is the left shoulder, this is the head, and this is the right shoulder. Okay, and usually the left shoulder and the right shoulder have the same area of interest. Okay, usually they have the same area of interest, and usually the head is just price stopping out these early sellers or buyers if it's an inverted head and shoulders, which I'll show you later on, right? So this is basically, if I was an SMC trader or ICT trader, the way they would explain it is price is going down, this is the early sellers, right? Then price goes up, induces the higher the early buyers, or sorry, early sellers in this case. What that means is basically, in simple term, guys, which I know no one's going to tell you, but in simple terms, it's basically just stopping out the small account traders. Okay, that's all it is, because usually small account traders are the traders that are ready to risk it all on these small little moves. Okay, it's usually the small account traders that enter early. Okay, the big accounts, the big boys, right? They're not going to be entering on this small little move. They're going to wait for a big move. Okay, but we're even smarter than that. Okay, and I'll tell you why. Because this is why head and shoulders is very important. Okay, when you have a head and shoulder pattern, right, the early sellers get stopped out. Now we can enter here, right, but there's no confluence for us to enter here. There's no indications or 100% guarantee that price is going to drop. Okay, so what we do is you wait for price to come down. Okay, give us that impulsive move to the downside, because price can easily just come up and then continue to go up. Okay, and then we wouldn't see that. But what it's done is now broken internal structure. Again, very important. Okay, broken internal structure. And then usually what we'd see is maybe price might break these lows to indicate to us that, hey, we are still going down, don't think we're going up. And then price will come to this area of interest where we can now enter, right? Again, this is an aggressive approach. Okay, and then what you can do is take an entry. So what we would see, right, is price at this level. Okay, we have the left shoulder, the right shoulder forming, and we've got the head. Okay, and then what we do is we go for a sell. This is again this is more of an aggressive approach. Okay, a sell against the highs and targeting the lows of the leg. Okay, that's an aggressive approach. A more simpler approach, which is more conserved. Yes, your stop loss will be a little bit less. Again, it's being patient. Okay, so we're going to show you another setup. Okay, you have had the confirmation of the left shoulder, the right shoulder, right? We've had the confirmation of that, okay? Put that a bit. We had this confirmation, okay? We have the head, right? Head and shoulders basically forming. What we would do is we would enter at the neckline. Same to this conserve trader. We will enter at this neckline. Now the neckline, okay, is this area right here. Okay, I'm gonna put this in, put it in red so you can achieve. This is the neckline. So every time price retests a neckline, that's where you are entering in the markets. Okay, and again, short position here. Stop loss can be just above and take profit all the way down here, and you'll actually see you have a larger risk to reward ratio when you're actually patient. Okay, now again, the reverse, okay, is pretty much the same thing, but it is the opposite. Okay, you have price coming here. Okay, again, waiting for that impulsive move. When we see that impulsive move to the upside, that's where we enter. Long position. And this is called an inverted head and shoulders, and obviously targeting here. Okay, and then the same thing as a conservative trader. Boom, 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 boom. Waiting for that neckline touch. Show you guys neckline touch right around here. We enter the trade on a long position. Boom. Stop loss can be really tight, and obviously targeting here. Okay, that's the reversal of it. Okay, again, making sure that the right shoulder and left shoulder are in the same area of interest. Okay, and the head is obviously the top head of the structure. Okay, when you notice this in the market, you're gonna see yourself seeing this quite a lot now. Okay, now that I've shown you guys, you're gonna notice this a lot. Okay, now when you ask me which one am I aggressive or conservative? It generally just depends on the volatility of the market. If the market is very volatile, I'll be aggressive. If the market is if the market is volatile, I'll be a bit more conservative. If the market is moving a little bit slow, I would move more aggressive because I don't mind risking a little bit more, right? Or having a bigger stop loss to wait for the market to make its move. Okay. Usually when the market is volatile, yes, it moves fast, but you can still enter on the wicks. You can still enter in a lower time frame. Okay. Remember, the higher the time frame, the better these moves are. Okay, so I use the 4-hour time frame to find key levels, and I go into the 15 minutes to see these structures. Okay, that's what I do. I'm going to show you. Okay, I'm going to show you, but what I want you guys to do is I need you guys and the keynotes are pretty much the same, making sure that the head and shoulder pattern are around the round psychological numbers. So for example, the area of interest for the right and left shoulder is at a round psychological number, and the neckline is also at a round psychological number or near a round psychological number. That's what would boost your setups to the next level. Okay, now I want to show you a few setups before we head on to the next day of the bootcamp. Okay, and I want to show you a setup on gold quickly because I trade gold, guys, and I want to show you, and the reason why I have my chart all blacked out is because when you're trading and you want to understand candlesticks, it's best to use a blacked out chart rather than having the green and blues or the red and greens or whatever it is you use candlesticks, because that kind of confuses you. When you have all black, it's like, okay, I'm just looking for structure. And that's why it's really important. Okay, now I'm just going to break down this trade for you. Okay, and I'm actually going to break down this trade without using any external factors, just based on the head and shoulder pattern. Okay, now for me, I actually traded this quite early on. That's why I had a bit of drawdown. But later on, I noticed that this was a head and shoulder pattern. Now you're probably wondering, how is this a head and shoulder pattern? I can't see it, right? Well, I'm going to show you a method that you can use so that when you're trading, you can actually use it, and it helps you visualize chart patterns. Okay, so for example, on this pattern, if I draw the first leg, come down, the second, come down, the third, and come down, right? Now I know this looks goofy, I know this looks funny, but if you look at it, right, and if you look at it as actually, if we look at it as the candlestick close, right, if we actually look at it as where the candlestick closed, because that's structure at the end of the day, right, where the candlestick closed, candlestick close here. And now if I move it to here, what does this look like to you guys? Right? And I want you to comment this down below actually. Time frame it and tell me, what does this look like to you guys? Okay. If you don't see it already, I'm gonna break it down even more. Left shoulder, right shoulder, head. Okay, and what happened? Price came down. Okay, now because gold's a little bit more volatile, gold would rarely come and test the neckline. Rarely do that. Okay, so on gold is a little bit different. Be a bit more aggressive. Okay, enter at this level right here. Okay, if you entered here after this impulsive candlestick, what would happen is you would barely have drawdown and you would have hit this trade right here. Okay, I can actually go on the 4 hour for gold and actually show you a better head and shoulder pattern. Okay, again, you can use your drawing tool. The drawing tool that I use is called the path. Okay, in case you're wondering. Again, the same thing. Leg to the up, boom, down, boom. Okay, and use the candlesticks, right? Don't use the wicks, because the wicks are not actually really there. They're invisible. Okay, boom, boom, and then obviously boom. Now guys, if I'm just moving this away, right, now move this all the way to here, what does this look like to you? Okay, doesn't look to the T, but what does it look like? Head and shoulder pattern. Okay, simple as that. Okay, I can do the same thing. Let's look at GBP JPY, because I know there was some moves here as well. Let's go on the 15 minutes. Okay, another pattern that I'm going to show you, another trading pattern. Okay, boom, psychological level, boom, to the next psychological level, to the next psychological level, to the up, to the down, to the up. Would actually use this, and then obviously down, retest. Okay, guys, what does this look like to you? Okay, we have an area of a neckline right here, area of a neckline, right? Yes, it's not to the T, but look, left shoulder, head, right shoulder, entry. Yeah, GBJPY, you can be a little bit conservative. Okay, and when you enter, look what happens. Okay, we enter at, let's say we enter at a strong bearish candlestick, so like here. Obviously stop loss will be a little bit high. Don't actually have to keep it that high, and keep it at these lows, and obviously targeting down at the leg, and look what happens. Yes, this is not the best trade setup, but we would probably target all the way down, so maybe like this key level, just to keep it a good setup, which you can see is on the way to that key level. Okay, and trading like that. Okay, now guys, I can show you endless amounts of chart patterns, like again here, right? Price goes down, up, down, up. Okay, guys, what pattern is this? Double bottom. Okay, where's the double bottom? At a key psychological level, 198. Okay, look, 198, key psychological level. Okay, and if you practice this, back test it, have a look, right, you will start to notice, right, price doing that. And if I just quickly show you, if you missed out on this double bottom, well, guess what, right? Guess what price does? It's amazing, because exactly what I showed you, right? Price retests the neckline, retest the neckline for you to enter, which I personally did. I did enter. Okay, and when you enter these kind of trades, you get to see a trade like a 1 to 6. Now the reason why I targeted all these highs is because I didn't actually have a take profit. Okay, so I just traded and I kept moving my stop loss till it gets to a key level. And when I started to see a reversal candlestick, I left the trade. Okay, I didn't actually leave it exactly at this key level. I left it a little bit earlier, but it's the same principle applies to, when you trade. It's the same thing. Double bottom, wait for this, be a conservative trader, wait for this to come down to the neckline. It did, and then you enter, and you enter for price to continue to go up. It's as simple as that. Okay, now guys, I want you guys, for your homework, I want you guys to practice this. I want you guys to let me know with the results you get, right? Practice, practice, practice. Okay, if you guys can't visually see it, use the path tool. Start drawing it out, body to body, body to body. Start drawing it out. Move it to the side. What does it look like to you, right? Okay, this looks like a double bottom. Even though all this looks like, this area just looks like consolidation, in reality it's building structure, it's building a pattern for us so that we can trade. That's all it's doing. Yes, it might not look, look like a double bottom, but it is, okay? So guys, for homework, I want you to practice this, okay? I want you to practice this. The weekend is coming up, okay? So I want you to practice this over the weekend as well. When the market's closed, back test, go back, have a look, right? And when you're back testing, you don't actually need to use a replay bar. You can do exactly what I'm doing. Just go back, look for double bottoms. Okay, I see a double bottom here. Boom, look at that. Right over here, boom, that's perfect, right? And practice, practice, practice until you become an expert at noticing these moves, okay? The head and shoulder pattern is a reversal pattern as well. But most of the time when you see head and shoulders, it's majority of the time it will go in that direction. It's very, very high probability trades, setups. When you see a double bottom, double top, it is a little bit lower, but guys, I rinse and repeat. That's what I do. I rinse and repeat. I keep doing it. I keep trading these styles. I've been doing it for 5 years, and I've just become more of an expert. But that doesn't mean you're not an expert. That just means that you just need to train your eyes to see these patterns. That's all you need to do. Train your eyes to see these patterns, reprogram your brain, forget about the all the other methods that other traders have shown you, and focus on this, because this is what is the reality. Like, I'm showing you guys the reality of the market. Like, I'm actually showing you, right? Even like just an example here, right? Boom, 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 boom. Guys, like another example, and I'm just gonna read this up. What does this look like to you, right? Yes, it might look mad, but this is what it is. Okay, guys. So, guys, we're gonna wrap it up here. Day 6 of chart patterns and entries and exits, and actually officially going into the deep end of the pool. If you guys enjoyed, make sure you like this video. If you guys are confused on anything, don't forget to comment down below, subscribe, and guys, please, please, please turn that bell notification on. Please subscribe so you don't miss out on any other days, because I'm going to keep going. I'm aiming to go until the end of the year on this boot camp to really fuel in and really pump you for the New Year's. So please join this journey. Please subscribe. Please turn that bell notification on so that you're always notified of my videos. If you guys are unsure when I upload, it's 8 p.m. every single day, UK time, Monday to Saturday. Sunday is your rest day. Sunday is a day where you can relax, but also do a little bit of homework, okay? Other than that, guys, hope you enjoyed, and I will see you guys in day 7.